What's going on, guys? This is Oliver, formerly from Response AI and a few other software tools that I've since exited. Today, the video is going to be a bit different. It's going to be about raising capital and getting early or angel or pre-seed investment. So in other words, you have an idea and you want someone to give you loads of money for it in exchange for, equity in your business or a stake in your business, kind of like, Shark Tank or Dragon's Den, that kind of thing. Now, raising early stage capital for a software business presents a lot of difficulty, right? So the pre-seed stage or angel stage is very, very early stage. It implies high product and market risk, right? So it's very, very early in your game as a founder, and you're asking for loads of money. You have to find people who are willing to take that risk. The model also requires a deeper understanding of recurring revenue. So how do we keep clients, and how do we keep people from stop people from churning and canceling the product so that we can build a really big business. And this video is basically going to be explaining how to do that and how to make your business attractive to investors. Also, there's a perceived risk of being a solo founder, which I know a lot of you guys are that are viewing this video. It's your status as a solo founder is risky. So you have no team, you have skill gaps, you might burn out because you're solo. And that's just what investors have to take on board if they're investing in you. The traditional model is hard for a solo founder. And the central thesis of this video is that traction is the antidote to, risk. For a solo founder, your primary task is not fundraising. It is proactively de-risking, your software or your business for the person who's giving you money. So in other words, just making your, business more attractive to investors. Now, something that actually prompted me to make this video is I've recently released a new software called Capfern, which is a database of verified emails and mobiles from seed investors, angels, and VCs. So I'm never going to make a video, guys, on software I don't use or, take money off someone to sponsor a video for a tool I don't care about. I'll never do that to you guys because I want to give you quality, advice and quality products to use. And this is just my database, basically. It's a brand new software tool I've launched. I'll be building this live and showing you guys how I'm growing it and getting customers for it. But if you guys are looking to actually find, investors and the direct dials and contact details of investors, feel free to use this. And I'll be talking about this more in later videos. So the Solo Founders Playbook for early and pre-seed SaaS capital. The control path, right? So you can leverage modern tools and AI like we do in this channel to build a profitable, capital efficient business. And it makes venture capital an option rather than a necessity. So I've never needed investment for a business, but if I've wanted to just speed things up after making it profitable and making it a good business, I can do so. And you guys can do so as well. If you guys have some revenue and you're doing okay, but you just want to do stuff a bit quicker, you can go and get investment. But you shouldn't get investment when you have just an idea and no proof that your idea is going to work. The growth path is that you use alternative and non-dilutive funding. So in other words, using like government grants or loans or revenue-based financing to fund growth without surrendering equity. For example, Stripe actually provide revenue-based financing when you start making some money with Stripe. So I think right now I could get 2K, off Stripe. They'd be giving me that with a pretty high interest rate, so it's not ideal. But it's better than giving away 10% of your business for that amount of money. Like, I'm not going to give away 10% of my business for $2,000. But the idea is that they will offer that if you start making some serious money. The scale path is that it's a tactical guide, to basically leveraging global investor networks and things like Capfern or things like, PitchBook or platforms to attract a founder's first angel and micro VC check. So that scale path we'll be talking about as well, and we'll just be basically going through all of these paths. Now, before an investor assesses a SaaS model or market, they assess the founder. So for a solo founder, the venture is presumed guilty of being a flight risk, emotionally volatile, lacking in critical skills, etc., until you prove them otherwise. And investors, guys, are basically risk mitigators. When they meet a solo founder, their internal due diligence memo flags several key risks. So burnout and key person risk. So a single founder bears all operational, strategic, emotional burdens, right? If that founder, if you burn out, you get sick, you die, you leave the business, you give up, the company dies. It's not like it gets given to your co-founder or given to the team. It just disappears. And on top of that, no single person, and I don't expect you guys to be, an expert in everything, in engineering, in marketing, in sales, in finance, in managing debt, in managing, tech. Co-founder teams are preferred because they, in theory, offer complementary expertise. My first proper successful software, Response AI, I was in a co-founder partnership. We owned 50-50, and it was awesome because that guy, who's still a good friend of mine, is amazing. He's one of the best and most talented people I know, and I couldn't have done anything without him. And nowadays, I do miss that co-founder setup because it's so fun. Now, the other side is that there's no diverse perspective. If it's just you, there'll be more blind spots because a solo founder doesn't have someone else to lean on and go, is this right or is this wrong? Difficult to work with. So an unspoken but legitimate concern is whether the founder is solo by choice or because no one likes them, right? So that can actually happen. Someone's like, you start working with some guy and you're like, I hate you, man. Like, you are annoying. You don't work very hard. You have stupid ideas. And that could be a possibility. You might be really hard to work with. And I'm not saying anything. I don't know you, but maybe you are. The pacing and scalability. A single founder is a natural bottleneck because investors fear this will inhibit the ability to scale quickly because it's only you and only your hands. Now, the perception versus reality. So the investor bias persists despite some conflicting data. So Crunchbase, they did a study that found that 52% of exited startups had a single founder, right? Suggesting that this is kind of all nonsense. You can grow a successful business as a solo founder. However, at the pre-seed stage, this data is irrelevant. Investors are not betting on exit. They're just betting on getting you traction and getting early stage, wins. The traditional VC model, which relies on pattern matching and bets, basically overwhelmingly favors teams of 2 or 3. Now, after facing rejection for funding, I was forced by investors to create a solo founder risk mitigation declaration. So I know that sounds like a long-winded thing, but basically it's a strategy to create a document that proactively basically says, this is why it's not going to fail, and these are all the risks that you don't have to worry about. So there's 5 perceived risks here. So burnout, skill gaps, sounding board, in other words, like no one else to advise or be advised by, difficult to work with, or bottleneck to scale. So the proactive mitigations that I effectively said to investors was, I have a documented support system and a personal runway of 18 months. I have savings, I have revenue, etc. I'm not going to burn out. My core strength is X and Y. I've explicitly filled my gap by retaining these customers or getting this help. And I have an advisor who's, a 20-year veteran, or my dad built a business, whatever it may be. Like whoever you can point towards to say they're helping me, or I don't have any skill gaps missing, which you obviously do. For the sounding board or someone, who can help you out, I formalize an advisory board that meets monthly. I have friends who I talk to, or I have advisors, or I have investors that aren't currently investing in me but are giving me advice, or whatever it may be. It's just another way of saying, like, I'm basically not going to fail because I have a community or a network of people who can help. You can even befriend people on LinkedIn and give them advice, or ask for advice, that kind of thing. You can pay for mentors, or you can join incubators, right? Difficult to work with. My solo status is a deliberate choice because I'm really good. Basically, my ability to attract people and customers demonstrates my capacity to build a team. And then bottleneck to scale. So my focus is capital efficiency. So by leveraging automation, advice from people, I've secured capital and that kind of thing. I got customers, whatever it may be. So you don't have to worry about scale because I will scale. Now, how to weaponize founder market fit. So the best defense is to reframe the solo status as an unfair advantage. The narrative shifts from I decided to start a company to I was compelled to start a company because it's what I need to start this company because I'm so good at X or Y field. The founder ideally should articulate why they have the specific domain expertise, personal experience with the problem, unique networks, whatever it may be. So example is with Capfern, I started the business because I know how hard it is to raise, and I knew how hard it was to find and how expensive it was to find the details and the verified emails or phone numbers, whatever it may be, to cold call these investors. So I just built that. That is specific domain expertise because I've been in that boat. The same thing applies to you guys if you have been a cleaner. You clean houses for 10 years. If you build a CRM or something like that to track customers for cleaning companies, that is a specific domain expertise and personal experience with the problem. So again, with that comes a unique network. And from that network, for example, I've built a network of people who run startups. So Capfern is going to grow because all of the people who run startups will want to get lists of leads and lists of investors. You see how that works. There's some kind of domain expertise. Now, a prime case study is Celine Haliwa, who was a solo founder who raised a $5 million seed round for her veterinary. It's helping pets be more healthy. Her unfair advantage was that she was a PhD candidate at Oxford in a relevant field and possessed a specific network of people who could help. Her founder market fit was so strong that it rendered the solo founder question irrelevant. No one cared that she was solo because she's so brilliant. And the pre-revenue traction playbook. So traction is the solvent for investor doubt. So if you have any traction, any revenue, a lack of that, a lack of being able to demonstrate momentum is fatal. Pre-revenue traction is the data that proves the thesis. So the hierarchy of pre-seed traction, investors see thousands of pitches and can instantly differentiate vanity metrics from validation. So are you lying basically? A waitlist with 10,000 signups is less valuable than 10 pilot users who are actively paying and using the tool. And from that perspective, the pre-revenue SaaS traction hierarchy, tier 4, which is weak, is vanity metrics like signups and waitlists and visitors to your website. Tier 3, which is good, is community engagement, people on a Discord or a Slack or some kind of private community. The strong tier is pilot users, so people who are actually using it, and they are using it every day. And then gold tier is commercial intent and paying pilot customers and a strong pipeline. So in other words, if you can say I've got 100 people waiting to buy this or 100 people who are actually paying for it right now, that is really good traction and indicators for investors. Now, building the right MVP. So the goal of the MVP is not to be a feature-rich platform. It is a tool for learning. It is a tool for showing an investor that you are building something that's worthwhile. Investors don't invest in, clean UI or something pretty. They fund momentum and they fund proof that you guys are growing a business. The MVP must be a sharp outcome MVP. So in other words, a user comes in with X pain and leaves with Y result. So example with Capfern, it's a very, very clear outcome. You log in, you pay, and then you get a massive list of seed and angel investors, right? So not to plug that again, but you come in with a problem, you need a list of investors, and then you leave with the result, which is a big list of investors with verified data. Again, with other software tools I've built, my last was a database of startups. Another one was an AI lead generation tool for Reddit and Twitter. You came on to getseer.com looking for leads online, and then you left with, a list of leads online. So that is a user coming with a problem and then leaving with the result. It should do one thing perfectly. An classic example is Dropbox, who their initial MVP, which is a 3-minute demo that validated that you could save files basically. And it was all of this complex engineering wasn't done yet. Today, a fully coded product might not even be necessary for a pre-seed pitch. A strong pre-MVP pitch, which has validation, a roadmap, some people who are paying for something. You can vibe code this, like I said, guys, and obviously just create some kind of momentum, either with paying customers or pilot customers for free. That can be sufficient to secure initial funding because people are interested in taking that gamble. Now, the MVP must be instrumented to track learning and momentum. So you need to think about engagement and retention. So how many people are daily users and monthly users? And this proves the stickiness of the product. So you can tell investors, people can't get enough of my tool. They're logging in every day. The retention rate is the percentage of users who return. This is arguably the most important metric for pre-seed SaaS or angel investment, because you are telling people telling investors that not only are people coming and paying, but they're actually coming back and continuing to pay or continuing to use the product, which is very exciting for investors. And the aha moments, the percentage of new users who successfully achieve the thing that you built it for. And that is really attractive to investors as well. And you can just ask users, did you achieve this? And they'll say yes or no. For B2B, the Net Promoter Score. So measures customer love and qualitative feedback. So you basically just get any NPS score software. It will send an email out to, like a message out to all of your users, and they will basically say, I like this or I don't. And if you have a high NPS, it shows that customers love the tool and they are happy to keep using it. And conversion rates, so tracking the percentage of users who complete key actions like a free trial and become a paid customer. So over the next couple of weeks with CapFern, I'll be tracking how many people sign up for a free trial versus how many people end up paying. And even if the paid tier is 0, tracking the intent to convert is key. And then pipeline growth, obviously. If you can show investors that you have hundreds of people that are actually signing up and you're trying to close deals with, that's huge. A tactical guide, so securing letters of intent. So for B2B SaaS, the LOI is a pre-revenue traction gold standard. So in other words, it's a non-binding document stating that a customer's intent to purchase is there if it meets certain criteria and if you build certain things. It's basically the strategic thing that helps you bridge the gap between a long sales cycle and getting funding. So an investor knows a big, complex B2B deal can take a long time, but the startup needs funding and you need funding. And the letter of intent serves as a valuable third-party proof point that the purchase is being considered by a user. So in other words, they haven't paid you yet, but they've said, I'm going to. And if you show an investor a few of these, it does help your case. I still wouldn't recommend doing this over actually just trying to get customers, because if you can get customers, it's obviously going to look way more attractive. Don't ask for an LOI up front. Interview customers, show mock-ups or demos, or recruit a small handful to get on board and try it. And once the MVP is solving their problem or their pain, make the ask. So to help me secure funding, Steve, I need to guarantee to investors that people are interested enough to give me letters of intent. And then would you purchase it for this price? And that's what you do. Now, I won't go through all of this because it's just how to build a letter of intent. But if you guys want to pause at any time, feel free to do so and read. Now, part 3 is the solo founder's capital stack. So an analysis of the process. So the micro SaaS revolution, which is driven by like vibe coding and AI, it's made building a $1 million ARR solo business more possible than ever. So founders like Danny Postma and Mauer Shlomo, they have no VCs and no employees, and they've proven that you can just build things and sell them, right? The path of the control path prioritizes total control. So no investors, no pressure, zero dilution of your shares in the business, and it involves validating idea, maintaining financial discipline, and then just building it and scaling it. The path is not anti-fundraising, it is fundraising agnostic. So basically by bootstrapping to 5 to 10K MRR, the founder de-risks the company. And if they choose to raise, they can do so from a position of power. So when we were sort of starting to really scale up with Response AI, we had that option to get funding, and it would have been quite easy for us to get funding because we already had revenue. If we had the idea and didn't get any money, we hadn't had any money yet, it'd be very hard to convince people to give us money. But we had that option to say, look, we are making money, so can you fund us? And we would have done so from a position of power because we already had customers. Now, alternative and non-dilutive funding, so the growth path. So RBF is a cash advance that is repaid as a percentage of a company's monthly revenue. And Stripe do this, for example. This is not for pre-seed or idea stage companies. It is for SaaS companies with consistent, repeatable revenue. So eligibility requirements are based on revenue. So general RBF providers may require a minimum of 10K in sales in a specific time frame or that kind of thing. So it's not for people who have nothing. It's for SaaS companies who have clear revenue. And we got offered revenue-based financing by Stripe, and it was pretty attractive. It's obviously quite high interest, like I said, but it can be useful for some people. Now, like I said, the RBF playbook is to fund an already growing growth channel. So if a founder knows, if you know that you can put $1 in ad spend and it gets you $3 out, you can use RBF to predictively grow revenue because you know that you'll actually make the money back and you'll be able to pay it back basically. Now, the scale path is the venture capital. So, or at the pre-seed stage, a founder is not pitching large VC firms. The targets are angel investors, like in CapFern, high net worth individuals who use their own money. They invest really early and are more sort of risk seeking. They're basically just gamblers. And it's a typical angel check that is 10 to 50K, and they do their due diligence. So it's not really gambling, but it's rather just, sort of small bets that they're happy to risk. And this is the primary target. So seed, very, very early angel to seed investors. Micro VCs, which are small institutional funds, they pool money into you and they give you checks of 25K to $500,000, and they often co-invest with angels and provide a lead check. So in other words, they sort of pool together and give you money. Again, there's a solo founder's sort of analysis of the different processes you can do here. If you want to, just pause the video and read, that's fine. But I won't bore you guys with this. It's just really good information from a table that I built, basically. So finding your investors, so platforms and databases. So finding the right pre-seed and angel investors is a problem. A solo founder can use modern platforms to run efficient research and find the correct investors. So platforms like Crunchbase and Shock, because it's mine, I'm going to say CapFern. Crunchbase is ideal for broad prospecting and finding recently active investors, and CapFern is a database of early stage seed and angel investors with their emails and mobiles available. So it's much more affordable as well. It's ridiculously cheap. And that's why I built it, because I didn't want to spend thousands of dollars ever again on finding investors. Then fundraising platforms like OpenVC and Gust and Vespi, they help founders find matching investors and manage their outreach pipeline more for like fundraising processes and things like crowdfunding, that kind of thing. Now, I'm going to talk to you guys about narrative and financials and how to like make a good pitch deck, right? Which I'll do properly in another video. It's the primary communication method for a solo founder to get funding. So you must be as clear as possible and as compelling as possible. A pre-seed deck is a narrative. It's about clarity, being concise and your vision for the product. It's a story, and the team slide is the moment to neutralize the solo risk by basically saying, I don't have a team, it's just me. But I have a network, or I have a specific bit of knowledge, or I have an advantage in the market, and that's what you can do. Again, I won't go through this because it's just a long thing, but in general, this pre-seed pitch and the actual deck should be title, problem, solution, why now, the opportunity, the traction that you have or don't have, the product and what it is, and you should show, not tell, the business model, the go-to-market strategy, how we're going to get our first 1,000 customers, competition, team and advisors, and then the ask. So we are raising 500K to do this. Can I have your money, basically? Now, the SaaS financial model, the purpose of the model is to not predict the future. It is to prove the founder understands the levers. So you need to make sure that investors know you know your stuff. The model should be a 3-year forecast, monthly for year one, and built on clear assumptions that can be changed. So things like what you expect the ARR to be, what you expect the customer acquisition cost to be, what you expect people to pay long term. So what will they pay in the full life cycle of their existence as a customer? So what will they pay you in total? How much you're going to churn customers, gross margin, and then my recording note is in the way of that, so I can't quite see it. And the model must demonstrate a path to a healthy lifetime value to cost to acquire a customer. So basically, how are we going to grow this profitably without losing money when we advertise or build content or that kind of thing? Now, lessons from the field before we finish. So like I said, Celine Haluia, I feel like I'm saying that name wrong, raised 5 million as a solo founder, and this is the clear playbook. She built an investor CRM of 157 investors. She then made it very, very clear to investors that there was going to be a 1 week period, and all pitches in the following 2 weeks would be operating on the principle that most deals die because of time, basically. So she knew that she had to get in front of investors quick, and she had to create that urgency. And then She iterated her pitch after every meeting, tracking these non-valid reasons for passing. For example, investors said, "Oh, I don't really understand this," or "I don't think it's going to work." And she eliminated those from her narrative so that she was only left with a pitch deck that showed all the things that investors loved. So traction, promises of it being good, promises of making revenue. And that's how she basically got her initial funding. It's just by being confident and creating urgency with investors. So that is the end of the presentation, guys. Obviously, if you want to check out CapFern, be sure to do so. Any questions at all, give me a shout, give me a comment, and I'll speak to you soon. Take care.